I'm Jamie Dragonetti, and my presentation is on government-sponsored enterprises and how they helped collapse the economy in 2008. There are three government-sponsored enterprises, also known as GSEs. I'm only going to focus on two of these today. The third one focuses on agriculture, so it's not really associated with my topic, but these include Fannie Mae and Freddie Mac, which are home loan mortgage corporations. One deals with commercial banks and the other deals with thrift banks. These are lenders who provide liquidity, stability, and affordability to mortgage markets. And the lenders use cash raised by selling mortgages to the enterprises to engage in further lending. So they basically take money from banks who loan the people money to buy mortgages, and they buy those mortgages and then trade them to investors and create more money. So Fannie Mae and Freddie Mac have created a secondary market in the home loan market. They sell these from banks. They buy them. It's freed up capital so that they can create more loans to people, and then they buy those and trade those as well. This definitely created some risky loans. They demanded loans, which led to the bank giving away loans to borrowers. I will talk about that more in a couple of slides down the road. And this then created an implicit guarantee. So they basically implied to borrowers, to people, to lenders, that the government would bail them out if they had any financial trouble whatsoever, and that their money was safe with them. Investors' money, homeowners' money, everything was safe with them. The disciplinary actions that ended up taking place, which I kind of wanted to tell you before I got into what they actually did, is that they ended up being put on a direct government supervision. So they were private companies that are now under direct supervision of our government, and the president appoints 5 of its board members, and it's regulated by HUD, which is the Department of Housing and Urban Development, as well as the Federal Housing Finance Agency, which handles going over all of their books and making sure that their finances are on point. But I wanted to go over the disciplinary actions that they received just so that you knew ahead of time that they did have measures taken against them, and you can kind of think about that as we go over the next slides. I'm going to give you a brief overview of the loan process. So first, a buyer buys a house. This creates a mortgage, which essentially is a piece of paper, which is actually quite important to know. A bank then has the opportunity to sell a mortgage to another bank or an institution, and then that relieves them of any responsibility of that mortgage. And then if a buyer defaults, whoever holds that piece of paper gets the house. So if the bank who sold the mortgage still holds it, they're responsible for the house. And if the institution who purchased the loan from the bank holds that piece of paper, the house is then theirs. And this does play an important part in this entire process and who lays blame where and why it was set up the way that it was and how it fell so hard. So the traditional mortgage process that it's been over the last 50, 100 years, maybe longer than that, however long people have been buying mortgages from banks, it used to be really strict. You had to have a down payment, you had to have good credit, you had to have good work history, and all of these made sure that you are a solid candidate to purchase a loan and borrow money. This changed in the 2000s when interest rates went down to stimulate the economy, and treasury bonds were basically worthless to buy. Investors didn't make any money off of them, and so the mortgage companies and the banks and Fannie Mae and Freddie Mac decided that they were going to start dealing in mortgage-backed securities, and these offered a low risk and high return, so they were super attractive to investors. And if they defaulted, they thought, who cares? The prices of houses are increasing, and we'll just resell this house that will be worth more to the new person buying it than the old person. So they were pretty confident that they were good loans and good investments, and they were going to make a lot of money on them for a long time. With the process that they were going through, investors were making a lot of money with super low risk, and they wanted more. They wanted to make more money. They wanted more loans to be created. So they called up banks that lended money to people and created loans, and they said, we need more loans. And the bank said, we've already given all of our loans out. We have no more people unless you want us to start giving loans to people who don't quite deserve them. And larger banks, institutions said, yes, do that. We don't care. Give it to us. And banks were like, that's fine. If you want the risk, we're just going to do this and sell them to you. You can have it. And they created subprime mortgages. These are definitely loans given to individuals with really poor credit history, people who shouldn't get loans, and that are just uneducated in this entire practice. And it also led to them having predatory lending practices. So they didn't verify any income. They didn't make sure that people were sound to be able to have a loan. And they also gave them adjustable mortgage rates because they made it sound so much better than having a fixed mortgage, and created a balloon and then a bust. After the bust, financial institutions stopped buying these loans. They were too risky. They owed a lot of money. So banks were then stuck with these subprime loans, and it then forced them to file for bankruptcy. So the Lehman Brothers, Merrill Lynch, they were both two major companies that ended up filing. And then investors started to really lose a lot of money. And this led to panic, which then halted all trading. Like, it just, everybody was panicking from all ends, and trading basically ceased. And then because of this, the stock market crashed. And it also had a little bit to do with other parts of the stock market that were intertwined with this, because banks and these securities were also using other things to back, their investments. And so it created just a huge stock market crash. When the government decided to step in finally, the Fed ended up giving emergency loans to the banks to prevent them from completely collapsing, because this would have been way worse if we would have just let the entire banking system collapse versus just bailing them out. In order to bail them out, they created TARP, which is the Troubled Assets Relief Program, and we just know it as the bank bailout. They ended up bailing out all the banks, and it costs around $250 billion. And in response to all of this, they created the Dodd-Frank Act, which just basically put a lot of restrictions on banks and lenders so that the American people could be protected, and it would prevent another financial crisis like the one in 2008. Basically, the entire thing that led up to this was just the moral hazard. It's just the banks taking on the risk because somebody else was going to have the burden. They didn't care. They were like, we'll take your loan. We'll give you a mortgage. We don't care because the risk is not ours. We're going to sell it in 2 days, in 1 week, and they get to deal with if you pay or not. And moral hazard is literally, I want to say, the reason that this happened. I don't have to deal with it. You can deal with it. Kick the can down the road and see where it lands. See who stops kicking it and who gets stuck with it. And we all paid the price for it. So my article that all of this comes back and relates to is about Fannie Mae and Freddie Mac, and Steven Mnuchin, who is the Treasury Secretary, and he has created a plan to privatize Fannie Mae and Freddie Mac again. He has said that this is the last unfinished business of the financial crisis, and he's really, really wanting to get this accomplished. In this, they've talked about paying for guarantees, in that it's a service that banks usually get free, but what they want to have Freddie Mae and Freddie Mac and Fannie Mae do is pay for the guarantees instead of getting them. And they also want to introduce some competition and get some other big companies out there to kind of pull back on them monopolizing and then having this issue pop up again. Investors have heard about this and they are anticipating this. And so with that, they've been pouring money into their stock again, and it's doubled in the last year. So they really, really want this to happen, probably more than anybody else, so they can go back to making money again. But Congress probably won't pass this, even though it probably would be a good idea. The federal government shouldn't have to have all of the work and the taxpayers' money paying to basically run all of this. It should be a privatized industry. Their loans, it shouldn't go through the government. These should be private. I do agree with that. I really did like this article. I thought it was pretty informative about what's going on now, and that is in the future versus what happened in the past, and how we're still being affected by something that happened over 10 years ago. So I hope that you guys enjoyed my presentation, and I won't make it any longer because I'm already over 10 minutes. I just wanted to add a bunch of information because I know that it is on something that is a part of our midterm. So if you guys watched it, you'll know that, and you might be able to help you. So thanks.